Stock markets at record highs, interest rates at record lows. Inflation in 2021, that's what we're going to be talking about today. Good evening and welcome back to Rainbow Investing, where we examine a spectrum of ideas to increase your long-term wealth. So the stock market has just ended 2020 at an all-time record high. And that's despite the global illness that has damaged economies around the world. What is going on and what does this have to do with interest rates? That's what we're going to be talking about today. And this issue, I believe, could be the number one issue we all face in investing in the stock market in 2021. So let's get into it. While we've all enjoyed the stock market's performance in 2020, a lot of people have been asking why. After all, as I covered in a recent video, the stock market has not been behaving in a very normal fashion in 2020. We had one of the shortest and sharpest crashes in stock market history, a period which does not align very well with what happened in the global financial crisis of 2008 and 2009. So if the global health pandemic is damaging economies around the world so severely, why is the stock market at a record high? Well, it's probably got a lot to do with interest rates. You only have to look at a graph of the S&P 500 over the last few years against a graph of the federal funds rate or interest rates. And you can see here that they are very, very closely aligned. One goes down, one goes up. And that has especially been the case in 2019 and 2020. Do you think it's a coincidence that the day after Fed Chair Jerome Powell announced a new quantitative easing program and record low interest rates, that the stock market started going up after falling very shortly and sharply following the onset of the pandemic? But why? Why does this happen? Well, to understand that, we'll have to talk about what exactly an interest rate is and what it does in the economy. Now, bear with me, I know this isn't the most interesting topic in the world, but it does have a big impact on stock markets. So for that reason, I think it's very important to briefly discuss it. So interest rates form a very pivotal part of what's called monetary policy, which is what the government does to stimulate the economy. It can either do this by government spending, which is also called fiscal policy, or monetary policy, which is tinkering with interest rates and quantitative easing. So interest rates are set in each country by the country's central bank. In the United States, that is the Federal Reserve. Now, once a month, the Federal Reserve sits down and works out what should be the funds rate going forward. At the moment, it is essentially zero, and that is one of the reasons why the share market is so high, in my opinion. Just before we continue, guys, I'd really appreciate it if you could hit the subscribe button if you haven't already and join the team. We're a small YouTube channel dedicated to personal finance, investing, and all things money. So if that sounds like your cup of tea, we would love to have you on board. So what exactly is the interest rate? Well, you can think of the interest rate as the cost of money, of borrowing money in the economy. If the Fed raises interest rates, it raises the cost of borrowing money. If the Fed lowers interest rates, it lowers the cost of borrowing money. In this way, the government can actually influence the economy by making it cheaper or more expensive to borrow money and service loans. Now, normally the government moves interest rates around to affect inflation and unemployment. That's the two goals that the central bank normally has. And of course, with the onset of the pandemic last year, the economy obviously needed a lot of stimulus very quickly. So you found the Reserve Bank easing monetary policy, slashing interest rates, doing quantitative easing on a very, very large scale. A scale we haven't really seen before in the United States. According to a recent report, 1 out of every 5 American dollars in existence today was created in 2020. That is a direct result of the Federal Reserve's monetary policy. So when the US Federal Reserve lowers interest rates, a number of things happen. Firstly, it is cheaper for everyone to borrow money across the board, whether that's businesses, individuals, governments. Interest rates are lower and therefore debt is less expensive. Now that's really good news if you have a home loan or a business loan or even a personal loan, because banks around the country are going to lower their interest rates on your loan, so you have to pay back less in interest. But it's also bad if you have money in the bank, because as you've probably noticed, if interest rates are lowered, the amount of money the bank pays you in interest for holding your savings in a bank account also goes down. And these reasons are partly responsible for why lower interest rates usually means higher stock prices. See, when interest rates get lowered, it actually lowers the appeal of many different asset classes to invest in. So mainly that's cash, what we just talked about with savings accounts, but it also means government bonds. Because if interest rates are falling, the interest that people lending money to the government through a bond can receive from that bond also goes down. So 5 years ago, a lot more people would have been interested in buying government bonds, investing in government bonds, than they are today. Because government bonds today offer extremely low interest rates, usually below 1%, and that's for many years. So with the government lowering interest rates, it has basically made entire asset classes less attractive to invest in, almost completely. And what does that in turn mean? It means that the asset classes that are left become more attractive to invest in. That's why stocks have been doing so well in 2020. Interest rates are nearly at zero, therefore stocks are much more attractive than government bonds or keeping your money in cash, especially when the government is printing so much money through quantitative easing programs. If 1 out of every $5 in existence was created last year, that means people aren't as keen to have their wealth stored in cash as they used to. And stocks are a good alternative. And that is why lower interest rates usually result in higher stock prices. We have seen this happen in 2019, in 2020, and we'll probably see it continue in 2021. And that is simply because there is no alternative, or TINA. You've probably seen that acronym before. It stands for there is no alternative, because there is simply no alternative to having your money invested, if not in the stock market. And that is quite simply because there are few alternatives for investors to have their money in apart from stocks when interest rates are so low. That's because other asset classes just don't provide the same kind of potential return. So let's talk about inflation for a little bit, because that is another reason why stocks have been climbing. So because of all this new extra money in the global economy, people are starting to worry about inflation. Because when you increase the amount of anything, simple supply and demand laws tell us that the value of it will fall. And because the government has been creating so many US dollars, a lot of people are scared of inflation and are worried about inflation because the supply of US dollars is increasing so quickly. So this fear is pushing people into stocks. But let's talk about what happens when inflation will actually hit the economy. If you're enjoying this video so far, guys, please be sure to leave a like on it. It really helps my small channel grow and this video to reach more people. And I would really appreciate it. So just go ahead and hit that big, nice thumbs up button below and turn it blue for me. I would really appreciate it. Thank you so much, but let's continue. So if we see a significant rise in inflation in 2021, it will not be long until interest rates start to rise. That's because inflation hurts everyone in the economy, and it's the central bank's job to prevent it almost above all else. So just because it might hurt the stock market, that does not mean the Reserve Bank will not start raising interest rates if inflation starts to rise. This, I believe, will be the single biggest thing we all have to watch out for on the stock market this year and going forward. Because once interest rates start rising, that nice tailwind we've all been enjoying over the last couple of years will suddenly turn into a headwind. And together with a weak global economy, it could mean bad news for the stock market. So how does one invest to prepare for inflation? Well, the share market is still a good place to invest because different businesses can overcome inflation. For example, if inflation grows to 5% this year, a company like Apple can easily increase its prices by 5% just to make up for that. In that way, it is an inflation-proof company, or at least inflation-resistant. We can see similar things with companies like Amazon, Coca-Cola, Pepsi, Facebook, Google. All of those companies have extraordinarily high pricing power, and that means that they can easily adjust their prices to account for inflation. So that is one avenue you can explore. I know Warren Buffett is very fond of investing in companies that have inflation-resistant characteristics, so check that out if you want some inspiration on that front. You can also invest in inflation-resistant assets or asset classes. So anything that has a finite supply is inherently inflation-resistant. So that includes things like gold, silver, precious metals, as well as cryptocurrencies like Bitcoin. There are only 21 million Bitcoins that can ever be mined, so they have a finite supply. And as such, they can be inflation resistant. Because of this finite supply, you can probably expect that any inflation that were to hit the US dollar to be unlikely to affect those kind of inflation resistant assets. So in conclusion, guys, inflation and interest rates are an area that I'm watching very, very carefully in 2021. I think that it has the potential to be the biggest issue of the stock market that we will face as investors over the next couple of years. And that's why I'm watching it very, very closely this year. But that's all I have for now. So thank you so much for watching. I really appreciate it. If you haven't already, please leave a like on this video and subscribe to the channel if you haven't already. I'll be back with some more videos soon. But for now, good night.